Nvidia just dropped a jaw-dropping $100 billion into OpenAI. But wait, what's the catch? OpenAI's buying Nvidia chips with that cash. Feels like a deja vu from the dot-com days, right? Enrique called it. This could be a wild ride. Stick around to see the risks involved. And yes, there's a hedge in play too.
The first topic that I've been writing about a ton over the last few weeks has to do with some potential hocus pocus. Nvidia last week announcing this deal to invest up to $100 billion. Here's the air quotes into OpenAI to build the OpenAI infrastructure. This is on back of the OpenAI $300 billion contract with Oracle that was signed a few weeks later. And look, I got a lot of thoughts. I'll let you start, though. Let's talk a little bit about what you've been saying about these topics. And I guess the overarching topic is we now have seen some very large investments in AI from a group of companies that are part of this Stargate development that are not part of the traditional cash flowing hyperscalers. And the scale and scope of these numbers are causing some questions given the lack of cash flow, revenue, profitability at OpenAI in particular. So,
right. All right. So we did talk about OpenAI last week in relation to the Oracle deal. But now let's talk about this Nvidia deal. Let's give people a little background in it. And I'm going to highlight some of your recent comments on the subject and some thoughts I've had on it as well. So what was announced last week was the headlines. They were technically correct, but very misleading, that Nvidia and OpenAI signed a letter of intent to deploy 10 gigawatts of NVIDIA systems to power OpenAI's next generation of AI infrastructure. Now, the headline said NVIDIA is partnering with AI and they're investing $100 billion into OpenAI. And when I first read the headline, I thought, oh, wow. So NVIDIA is going to write a check and OpenAI will have $100 billion. That's a lot of money. It's a lot of cash, but that's not really what happened. So what's going to happen here is NVIDIA is going to build out the system. And so, to the extent that they're giving OpenAI the money, OpenAI is using that money to buy NVIDIA's best chips, right? It'll be the Vera Rubin architecture next year. So basically, another way to look at this is NVIDIA is partnering with OpenAI and buying $100 billion of chips from itself, right? And these are the kind of really interesting accounting shenanigans we saw about 25 years ago, right? Where basically it's a financing deal, and NVIDIA is giving OpenAI the money, but OpenAI is using that money to buy NVIDIA chips. And so somebody might say, well, wait, why are they doing it that way? And the reason is because NVIDIA can count that as revenue, and trading at somewhere in the neighborhood of 40 times free cash flow. NVIDIA needs a lot of revenue growth to keep the stock valuation where it is. Now, let's go to some of the commentary on this, which I think is really interesting. One, and we'll get to you in a minute on this, Enrique. Last week, we were quoting you, talking about your comparison, saying OpenAI looks to you a lot like Enron did 25 years ago. And one of the things you cited were these gigantic long-term contracts. And like, wow, Enrique wrote that a week ago. And then, just a couple of days later, we get the deal with NVIDIA, $100 billion. That's a big headline number. So I think you are very prescient on that. The other thing is I revised my opinion on this. Last year, people asked me, hey, don't you think NVIDIA looks a lot like Cisco from 25 years ago, right? They're both selling the architecture, right? Only Cisco was selling all of the servers that the .com companies were using, and NVIDIA, they're selling the chips that everybody's AI is based on. And, I said, I see the comparison, but I don't agree. And the reason I didn't agree was Cisco was selling servers to pets.com and other companies that, their business plan was to sell dollar bills for 90 cents, make it up on volume, and try to monetize, the eyeballs that they had access to. Nvidia, on the other hand, their big customers were gigantic hyperscalers that had unlimited free cash flow companies like Google or Alphabet, Facebook or Meta, Amazon, right? And so, you look at that and you say, wait a minute, Nvidia's customers actually do have money. They have business. They have businesses. This is real. And I said, it's not the same. Well, now we're in the financing yourself and paying somebody else to give you revenue part of the show. And we might need to revise that opinion. And so, the comparison, and Enrique, I'm going to ask you about this. You're comparing OpenAI to Enron from 25 years ago. Do you still think that, and why? And should we now be comparing Nvidia to Cisco from 25 years ago?
So, look, there's actually a lot more nuance to this. And let me start with something. The 25 years ago, Enron had a real business, okay? WorldCom had a real business. Those would be two companies that I would highlight that were focused on bandwidth, energy, kind of like all the things that were happening and that were hot at the time. So it wasn't that they were fraudulent per se. They ended up actually having some fraud in the numbers, but they were capitalizing on very real things. And as you went through the course of the cycle, what happened was the later stages of having to keep that growth going, or the perception of growth, reached a stage where we really were just overcapacitized. And so what happened with the telecom cycle, we had all of these fiber builders, the CLECs, the cable companies. I was a big investor in Flag Telecom, which was building a cable across the ocean. And what's interesting to me about all of that, none of these companies did anything wrong. Enron and WorldCom did, actually. But my point is, as an ecosystem, none of the companies did anything wrong. And when you look at what was happening at the time, when Cisco and Corning, which was the maker of the fiberglass, they would get up and they would say these incredible numbers, I think the companies believed them. And when I look at what, let's look at each of the players here. Like OpenAI, I think is doing the rational thing by trying to raise as much money as they can and build as much as they can as quickly as they can, because it's really one of these get going while the going is good. And so I don't fault Sam Altman for putting these ridiculous things out there. And I think his goal is to try to get as much money in the coffers as he can. And he does fundamentally believe that it's all going to play out, as do I. It's just a matter of timing. And so I believe Jensen too. But one of the things that really gets me is I hear this story. So, dude, railroads, okay? Radio, electrification, television, the internet, mobile phones. We've seen this cycle over and over and over. And what I'm loving on the TV right now is I'll get, and I actually like Jim Cramer, but Cramer will be like, but you know what? Jensen sees everything, so Jensen knows more, okay? No, Jensen's on the same wave. And what is Jensen supposed to say? What is Jensen supposed to do? Is he supposed to say, hey, no, Sam, I don't want you to buy $100 billion worth of chips? How's that supposed to work? That he's supposed to go, hey, guys, you know what? I think we might be making way too much capacity and way too much chips. We're not going to sell anything more to you. Well, that's never going to happen. So when you get into this part of the cycle, no one's actually doing anything wrong, in my opinion, in this cycle. We'll see about Sam Altman eventually. That one kind of sketches me out a little bit. But I think they're all acting rationally, but acting rationally doesn't mean it ends well. And, even when we talk about what I'm fascinated by now is the relationship of the traditional hyperscalers, Meta, Amazon, Microsoft, etc., because they do have cash flow. But you know what they can do? They can stop spending and let their cash flow explode and still be in the best position because they don't have to raise any money to go out and do all this stuff. So, look, I was thinking of analogies here, and the best analogy, I'll share a couple of them real quick. I love surfing analogies. I love water analogies. This is like we know there's a hurricane coming in and we're out on Long Island, but until the hurricane hits, dude, the waves are going to be awesome. The best waves you'll see all year, and depending on the size of the hurricane, the best waves you'll see all decade. The key, though, is when you go out and surf those waves, you may get some of the best waves you may see in the next 10, 15 years. But when that hurricane actually gets there, you're going to get killed if you're on those waves. And that's kind of how to approach this. So when I published a piece in a publication I have called Truth and Trends. You guys can just go to truthandtrends.com last week. And I gave a whole bunch of data why I'm very bullish, believe it or not. But then I ended with the 98 example. Okay. I started my career as a money manager in 1996, was managing $250 million by 97. And 98 was the long-term capital debacle. I won't go too much into it. Big leveraged hedge fund exploded. People were concerned that it was going to bring down the entire capital markets. And at the time, the Fed cut 75 basis points in short order with the market near its highs. Now, it had come off because of LTCM. But what that set off is it was basically the spark in that late stage. We were already 2-3 years into the internet spend, which, by the way, I'm going to argue we are here now, because remember, 2023, 2 years ago, is when we really set off the AI spend. So it's not 6 months anymore; it's 2 years. And so what happened in '99? S&P was up 24%. The Nasdaq was up 85%. I mean, people ask me the craziest things I've ever seen in my career. I was at my desk for September 11th. I saw the flash crash. I saw global financial crisis. I traded through COVID. That melt up in '99 was the craziest thing I've ever seen by far. So bringing this all together, do I think these people are doing something bad, fraudulent, etc.? No. Do I think this is going to end badly with stock prices for many of these companies, Nvidia, so these direct companies, much lower for a period of time? Absolutely, yes. Do I think that OpenAI even exists in 3 years? I doubt it. Okay. I think it gets sold for $50 billion. But there's this weird juxtaposition that right now we've got the best waves we might have for the next decade. So we're actually helping people surf those waves, but we're getting ready for that hurricane to roll through. So it's sometimes as a trader and an investor, you have to exist in two places at once in your brain. I use the example of blackjack. If you're a cold killer blackjack player, which I happen to think I am, I'm pretty good at it. You actually have a slight disadvantage against the dealer. You're going to walk to that table, you're going to lose slight majority of the time. Yet you go up to the table and you can win with good money management by playing perfect blackjack and knowing when to walk away from the table. And that's where it's like, I know I'm going to lose, but I know how to win. And that's where I think we are in the markets. But yes, this will end very, very, very badly. One last thing, I just want to go off on one company, Oracle, man. Like I don't know if people realize Oracle's levered like 4 times net debt to EBITDA, 500% debt to equity. This company has 110 billion of debt. So when we talk about Microsoft, awesomest balance sheet ever, Meta, awesomest balance sheet ever, Amazon, awesome balance sheet ever, and we put Oracle in this group, Oracle right now trades at a higher multiple than Nvidia. And Oracle has been missing numbers. They missed that quarter. They missed it by 1%. And all they did is said, hey, this backlog that's being financed, I don't know how, went up fourfold. But yeah, we actually missed our numbers right now. So like one company to focus on. I'm full disclosure, I'm long February and March 260 puts in Oracle. And I absolutely love that trade even now, even though I've doubled my money in the last week. So yeah, I think this is, and I will give one last thing, which is, I think I just posted this on Twitter. Professor Scott Galloway has this guy, I think his name is Ed Olson, works with him. He posted this stat that in 1870s, 20% of U.S. capital investment was going to railroads. Right now, it's just about 2% to AI. But in the 1870s, less than 0.1% of Americans owned stock. Today, that number's 62%. And by the way, about 40% of that is AI related. So when this bubble pops, this will be what causes the recession when data center spending comes down, and it's going to hit the stock market. So again, let's catch these tasty waves, but like be ready, be prepared.
All right. So double points for quoting Jeff Spicoli. I caught that one. And I think, it's a really, really astute analysis, Enrique. The one thing that I'm going to add to that, I don't know if you read Stephen Innes. He writes a great Substack called Dark Side of the Boom.
Okay.
He writes a lot on macro, on currencies, currency trading. But he pointed out last week that 9 of the 10 largest US companies are AI proxies. The 5 largest make up 20% of global market cap. And now I'm going to point out that if you're right that, there's an issue at Nvidia and Oracle, Microsoft and Google might have great balance sheets, but once these stocks start to crack, they're all going down. And the entire market is very, very, very leveraged to a very small number of companies, all with the same investment thesis. And so once those multiples start to collapse or implode, everything is going down, right? It's not just going to be Oracle, Nvidia, and whatever private market valuation there is for OpenAI, right?
Yeah.
The whole sector is coming down.